Hello and welcome to the Investing Insiders podcast, where we help you to achieve financial well-being by making smarter money decisions. I'm Brianne, and today we're going to be looking at our money mailbox again to answer some of your financial questions. This episode is sponsored by Saxo Markets. Before we begin, it's important to note that the information shared during this episode is for general information and educational purposes only and shouldn't be considered financial advice. Any products, platforms, funds, or services that we reference are for illustrative and informational purposes only, and their inclusion shouldn't be interpreted as a recommendation or endorsement. You need to make sure that you do your research and choose something that is suitable for your personal circumstances. So with all that being said, let's get into the show and answer some of your questions. Our first question comes from Callum, who asks, what is the best account to use to save for a mortgage? Callum, that's a great question. And putting together a house deposit to secure a mortgage is not an easy feat, and there are lots of options available. So the best one will depend on your circumstances and when you're looking to access the money. So looking at the savings route, which typically is suitable if you need to access this money within the next 5 years or less, you have savings accounts. So easy access savings accounts give you unlimited access to your money. So you can add money to the account, you can take money out of the account with very few restrictions. You also have regular savings accounts. So these are when you can add a maximum amount of money to the account each month, usually around £200, £250. They tend to offer higher levels of interest, but obviously the amount that you put in is capped. So that's something to be aware of. And then there are fixed rate savings accounts where you lock your money away for a certain amount of time. This could be, anything from 6 months all the way up to 7 or so years, depending on the provider. And you'll earn a level of interest on the money that you save into that as well. But obviously there are some restrictions on when you can take the money out. So factor that into when ideally you'll need to access this money when deciding which of those accounts might be good to use. Another type of account that is possible to use for this is an ISA, so an individual savings account. And these allow you to save money tax-free, up to £20,000 at the moment, although from April 2027, the ISA allowance for cash ISAs will be falling to £12,000 if you're under the age of 65. But for now, you can put up to 20,000 into a cash ISA. Again, you can get easy access where you have, freedom to put money in or take money out as and when you please, or you have a fixed rate cash ISA where you'll lock your money away for a certain amount of time and you'll be able to access it after that point. Within the ISA branches of accounts, you also have the lifetime ISA. So a lifetime ISA is an account for people aged between 18 and 39 to save for their first home or retirement. So you can put in up to £4,000 each tax year until the age of 50. And, there aren't any taxes to pay. And also the government pays a 25% bonus up to £1,000 as well. So the lifetime ISA is slightly more tailored to saving for a first home. There are a few caveats with that. The home needs to be under £450,000 to qualify for using the money towards your home. And you also should be aware that the lifetime ISA itself is going to be replaced by a first-time buyer ISA in April 2028. So with that, there are a few things to consider as well, and just making sure that that offers the right level of access and growth that you need to put money towards buying your first home. And the final type of ISA, which could be an option to explore, is a stocks and shares ISA. So this is an account that allows you to buy, sell, and hold on to different types of investments. So think of things like stocks and shares, bonds, funds. You can purchase them all, hold them in the wrapper that is your stocks and shares ISA, and invest money essentially to put towards your house deposit. So the thing to ask when thinking about all of these different types of accounts is, when would you ideally need to access your cash to put towards your home? If you're looking to have this money together in a shorter space of time, potentially thinking about the cash savings options might offer more flexibility and give you the opportunity to, you know, give your money a boost in the short term and have it ready to put towards your house deposit. If, however, you have a longer time horizon, so thinking about maybe 5 years or more, then potentially considering investing to build up that house deposit is an option to consider as well. Having a longer term horizon allows your investments to bounce back if there are any changes in the market that could affect the value of the investments that you're holding on to. Typically, when things happen, so for example, if there are market shocks, so the market crashes and your portfolio might lose value, if you give it a bit of time, it often bounces back. Although, do remember that past performance doesn't necessarily predict what's going to happen in the future. Just giving yourself that time allows the opportunity for things to balance out again. So when it comes to putting money together for any life goal or financial aspiration, one thing to bear in mind is that you don't have to just use one option. So although we've laid out all of these different things that you can consider, and it's worth going away and just having a look and seeing what would work best for your particular circumstances, remember that you can use a combination of them. You might decide to invest some money and have some in easy access savings. You might decide to just use investing as your strategy to build the money that you need. It doesn't have to be one or the other. And another thing that you can do is, if you feel like saving is the route at the moment, but then once you get to, say, the end of your fixed rate account, or you've been saving for 2 or 3 years and your circumstances change, perhaps the home buying process, you might decide that you want to give it a bit more time. At that point, you might decide, okay, maybe I will consider investing alongside it. You don't have to kind of fix onto one strategy now. Have a look at the different options available, see what might work, and whichever options you decide, some of the things to make sure you do is compare different accounts and different providers. So look at the interest rates that are on offer, look at the terms of the different accounts. Are there going to be restrictions on how much money you can put in or money you can take out, or how frequently you can withdraw money? With the stocks and shares ISA providers, look at the different types of fees you might need to pay, as that will affect how much money you'll have in totality when it comes to, using it for your house deposit. And for other things like the lifetime ISA in particular, just looking at the different terms of that. So for example, are you going to be looking for a property in an area where it goes above the threshold of what you can use the lifetime ISA for? It's just little things like that to then go away and do a bit of digging into and seeing if that would suit what you're looking for in terms of purchasing a home. But best of luck with putting together your house deposit, and hopefully one of these accounts or a combination of these accounts will help you on your way to making sure you can get onto the property ladder. Our next question is from Mary. Mary asks, will I still qualify for the state pension if I take time out of work to look after my children? So that's a really good question, Mary. And the short answer is yes, you absolutely can. So the state pension is a benefit that you get from the government once you hit state pension age. To qualify for the state pension, you need to make a certain amount of national insurance contributions for a certain number of years, and these are called qualifying years. So normally you need at least 10 qualifying years to get the minimum state pension, and then you need at least 35 qualifying years to get the full state pension at the moment. So national insurance contributions can be made up of tax taken from your income. They can be made up of national insurance credits, and they can also be made up from voluntary contributions that you make as well. So if you need to take time out of work to care for a child or even an adult due to illness, you might be able to claim national insurance credits to help you qualify for the state pension. So these credits help you build up the number of qualifying years which you have, and that can increase the amount of state pension that you qualify for, or if you qualify for it at all. So in your case, you can apply for child benefit, which you can apply for online, and you can make a child benefit claim 48 hours after you've registered the birth of your first child or once a child comes to live with you. And child benefit can also be backdated up to 3 months from the date that you make a claim. Some of the things to bear in mind with child benefit is that if you or your partner earn over £60,000 per year, you'll have to pay the high income benefit charge. Or if you or your partner earns over £80,000 a year, you'll have to pay back the child benefit. However, what you can do if your income is above this threshold is just opt out of having the child benefit payments and just get the national insurance credit for the child benefit instead. So you can check your state pension forecast on gov.uk to get an idea of what type of state pension you're on track to get, and just make sure that you're applying for at least the child benefit national insurance credit. Even if you don't get the payment, just making sure you have the credit to build up those qualifying years for any time that you're outside of work, and making sure that you can get as much of the qualifying years you need to qualify for the state pension. So thanks for sending in your question, Mary. Hope that helps. Our next question comes from Daniel. Daniel asks, how can you check what's in your pension? That's a really good question, Daniel. And to check what's in your pension, there's a general framework that you can use for all of them. The ability to access it might just depend on the type of pensions that you have. So if you have a workplace pension, you just need to find your pension provider and get into your account. Usually you'll have some kind of pension statement, and on that it will have some instructions for how you can either log into your pension account or contact the pension provider to get an idea of what's going on with your retirement pot. If you don't have access to your pension and you know that you have one, getting in touch with your employer can help you find who the pension provider is and connect you with the details that you need to get into your account and see what's going on as well. If you've left a job and you know that you had a pension, but you just can't remember what it is or can't find the details of it, using a free pension finding service can help you. We've partnered with Gretel to provide a pension finding service for free, which allows you to put in your details and it will pull up any old pensions that you've had in the past. So once you've got that information, you can go back to the providers and contact them for the details to get into your account and have a look at the different pots. Decide if you want to keep your pension separately or if you want to combine them into one pension. And that should give you an idea of how much you have, whether or not it's on track for the retirement that you'd like to have, and decide if you want to keep it invested in what it's currently invested in, if you want to make some adjustments, just to have that agency over what your retirement income looks like. If you have a SIP, so a self-invested personal pension, those details should sit with you somewhere. So If you don't have them currently or you've lost track of the details, getting in touch with your provider and going through their pension account finding process will help connect you with your retirement pot, help you get into your account, and again, let you decide if you want to keep your pensions where they are, if you wanted to move to another provider, or just switch your investments around as well. One thing about pensions is that they can feel a little bit complex at times. So if you really are struggling with all of the different options that are going on, sometimes speaking to a professional pensions specialist can help, just help you get an idea of what's going on, the different options available to you, and the next steps for making sure that you have enough for a comfortable retirement. So that does often come with a cost. However, you might be able to get some support through your employer. So having a look at your employment contract and the benefits available through that, you might be able to speak to somebody for free or at a reduced cost. You might also be able to speak to someone in your HR department and get some guidance on how to manage all of the different aspects of your pension savings and making sure that you've got enough in your retirement pot. It's great taking that first step and checking what is going on, because awareness is always the catapult into making sure that you know what you're doing and you're saving enough, making sure that your investments are in the right place, and pulling everything together. So hopefully this helps you get an idea of what's going on with your pension income. And if you want to make any tweaks, any changes, you can take it from that step onwards. This episode of the Investing Insiders podcast is sponsored by Saxo Markets. Saxo provides access to a broad range of global assets through a sophisticated trading platform. You can trade US stocks from as little as $1 per trade and UK stocks from $3 per trade. Please remember that all investing involves risk. The value of your investments can go down as well as up, and you could get back less than you invest. Terms and conditions apply. Visit Saxo Markets to learn more. Our next question comes from Emily. Emily asks, if you have absolutely zero savings, which one would you go for, a cash ISA or a stocks and shares ISA? That's a really great question, Emily. And when it comes to savings, it's important to think about your financial circumstances as a whole. So if you don't have any savings, also look at other aspects before trying to build up your emergency pot or save for an aspiration. So any expensive outstanding debts on things like credit cards or high interest loans, if you have that going on, it's important to pay all of that off, because the interest that you might be accruing on that will outweigh any returns that you get on your savings or your investments. So it's important to take care of that first before moving into your savings and investing strategy. However, if all of that's been squared off and you're kind of starting from the foundation of, okay, there are no high interest things to take care of. Now it's time to focus on building wealth. Saving is great, and using easy access accounts that we mentioned earlier in the episode. So things like an easy access savings account or an easy access cash ISA, it gives you the ability and the flexibility to withdraw or deposit money into your account as much as you like. So that tends to be quite good for emergencies if you're looking to build a pot to cover things that happen unexpectedly. If you have a boiler breakdown or car troubles, or just, anything that comes up which isn't within your budget, you at least have that cushion to cover you for it without having to necessarily borrow or things like that. So an easy access account would be a flexible option to consider and gives you that opportunity to use the money when you need it for emergencies. When it comes to using things like a stocks and shares ISA, that's looking more towards the investing side. So that type of account allows you to buy, sell, and hold on to investments, which also gives you the opportunity to earn a return. However, it might offer better opportunity if you're looking at something long term. So if you're looking to put your money away for at least 5 years and giving it a chance to work through the stock market to, if something happens and there's a market crash, like your money might have time to recover. For those longer term aspirations, investing can give you the opportunity to earn a return and bounce back from any of those market shocks that might happen. Again, when looking at your strategies for either building wealth or trying to achieve a financial goal, you don't necessarily have to choose one or the other. You can always use a little bit of both. So as you're starting from your foundation, you can try saving a little bit. You could put your money into different types of savings accounts. So as we mentioned earlier in the episode, yes, there are the easy access accounts, but you can also lock your money away for 1 year, 2 years, or 3 years. That's also an option too. And then looking at the investment side, depending on how comfortable and confident you are with investing, you might want to start small and drip feed money into your account. Get comfortable with the idea of investing, seeing how your portfolio performs, understanding the idea of risk and the impact that it plays on the performance of your funds as well. And then just seeing how things go. Like it's all about measuring and then revisiting. So you don't have to commit to one or the other right now forever. You could use a little bit of both, decide which one is working best, and then just keep revisiting and making minor adjustments as time goes on. One thing to bear in mind, so with savings accounts, particularly if you go for a fixed rate savings account, that fixed rate deal, once it ends, you'll automatically get shifted onto the variable rate account of that provider, which doesn't tend to be the best paying when you compare it to other accounts. So you really do need to make sure that if your fixed rate account is coming to an end, you take the time to do the process again where you compare different providers, interest rates, and move your money where it's going to benefit from the most amount of interest or growth. And with your stocks and shares ISA, when you're thinking about different providers, do look at things like fees, do look at the different educational resources available, particularly if you're just getting started out. Those market updates that you might get, or having different explainers or videos and resources like that, it always just helps you feel a bit more engaged and helps you understand what's going on in the market so you can make decisions that work best for you. Also, if you prefer more of a hands-off approach when it comes to investing, many providers offer ready-made portfolios. So this is where they put together a group of investment assets, stocks and shares, funds. It might just be different types of stocks and shares from a different region or a certain industry. Similarly with funds as well. All of that's taken care of for you, and they're categorized usually according to risk. So lower risk up to higher risk. And you can choose one and see how things go with that as well. There's lots of different aspects to consider for both, but the main one to kind of get an overview of what each has to offer. Savings is ideal usually when you're looking to access or need to access money within, a 3-year or less period, whereas investing provides longer term growth for 5 years or more. Thanks for sending in your question, Emily. Really hope that helps. And our final question comes from George. And George asks, what is a credit score and does it really matter? That's a really interesting question, George. And first of all, your credit score is a measure that lenders use to see how well you manage borrowing and see how well you're good with managing money. So your credit history is the blueprint of all the different ways that you've borrowed in the past. And borrowing can include credit cards, it could include loans, but it also includes things like your mobile phone contract and how well you've managed to keep on top of the different repayments. So there are three main credit reference agencies in the UK: Experian, TransUnion, and Equifax, which measure your credit data and give you a score based on everything that they know about your financial history. Each lender, each credit reference agency has a slightly different measure of how the scores are benchmarked. However, essentially what your credit score does is it just lets you know, because you can log into different credit reference agencies to see what your score is and have a look at your history as well. Is your credit score important? It is, because essentially your credit score and credit history, it will influence the types of deals that you have access to. If you're looking to get a credit card or a loan or even a mobile phone contract, the offers available to you will be influenced by how well you've managed money in the past. And it could be the difference between the different types of mortgages that you're offered. It could be the difference between the different types of loans that you're offered. Sometimes, depending on the jobs that you're looking for, it could be used within the data to check if you're a suitable candidate for the role as well. So your credit score is really important. It doesn't necessarily mean that you have to go out and, borrow lots of money and pay it back to prove that you are good at managing money. Simple things like making sure you pay your mobile phone contract on time, keeping up with energy bills and things like that too. It all counts towards your score. Some things that you can do to improve your score as well include registering on the electoral roll. So registering to vote. That helps to confirm your identity and make sure that everything is linked in the right way too. Some of the other things is making sure that you don't make too many credit applications at one time as well, which if you are looking for a new credit card or looking for a loan, the natural thing to think is, okay, I'm going to put some applications out and then see what comes back. Putting out too many applications, it might give the impression that you really need the money and might not be able to pay it back. So the best thing to do in that case is to use an eligibility calculator instead. So these are free tools online which allow you to make an application. It will do a soft credit check, which means that it won't appear on your credit file. And you can get the different types of products that you'd be eligible for to enhance the success of your application. It doesn't guarantee the success. However, it's just going to help you sort through what's realistic and, which providers are more likely to accept your application. If you do get accepted for a line of credit, making sure that you repay it on time and clear your balance, all of these things over time, it really does make a huge difference. And even if you have a lower credit score or you don't have a credit score at all, because if you're just starting out in the financial world, you might find that there's just not enough data on how you manage money for the credit reference agencies to give you a score. Regardless of where you're starting, you can always improve your score and always just take these little steps to see those things improve over time. So thank you so much for sending in that question and really hope it helped. Thank you so much for joining our Investing Insiders podcast. If you liked the episode, please subscribe and leave us a 5-star review on your platform of choice. For the latest money news and deals, you can sign up to our weekly newsletter at investinginsiders.co.uk/newsletter-page. We've also got a suite of guides, tools, and calculators on our website at investinginsiders.co.uk. You can also keep up to date with us on TikTok, Instagram, and YouTube. Thanks for joining us, and we'll catch you in the next episode.